I've been at ASX for 7 years now, and without a doubt, I think the last kind of 3 years has been the most exciting time that I've seen at ASX, particularly in this listed product area. And thanks to Pinnacle for flying the flag for everything listed and running today's and education sessions like today. As has been mentioned, we've seen tremendous growth in listed products or investment products that are available via ASX. As at the end of June, exchange-traded products hit $50 billion, so quite a milestone for exchange-traded products. They've been available for around about 18 years now on the exchange, and we've seen tremendous growth in both the range of funds that are available and the asset classes that are available through ETPs. LICs and LITs are not far behind. They're at $45 billion, and again, as Chris mentioned, we've seen tremendous growth there, but also real diversity in terms of the underlying asset classes that can be accessed through LICs and LITs. One of the other products that we look after from an ASX perspective are M funds or unlisted managed funds. Not quite as old as ETPs or the listed investment company and trust market. They've been around for about 5.5 years and are almost at $1 billion, but we've seen really good supply side, so the number of funds available as M funds has also been very impressive. So suffice to say, there's plenty of choice for investors and advisors on ASX in the vicinity of over 500 funds, of course, in addition to the direct equities and A-REITs that are available and other types of products that are available through ASX. I suppose the key question is, what do we believe is driving this growth? And from my perspective, I wanted to touch on really 3 things just quickly that we think is driving the growth. The first one is financial advisor adoption of listed products and that move off platform. And when we look at the data of where investors come from and how they get access to ASX, I've actually referenced here one of our clients, Macquarie Online Trading. And when they look at their investor database, they can see that from investors that are advised, which is the top line there, or self-directed investors, investors that received advice are over 4 times more likely to use an exchange-traded product than those self-directed investors. So we're seeing huge, I suppose, recommendations coming through from financial advisors to drive those investors into exchange-traded products. In addition to that, ASX runs its own education series on everything ASX. What's really interesting to see is of the financial advisors that attend our workshops, 68% of them recommend ETPs. That's the second most popular structure to recommend. So shares, of course, being the first one, but ETPs far and away ahead of A-REITs, LICs and unlisted managed funds. So again, huge growth in advisor adoption of listed product. The second driver, which I'm sure won't be a surprise to you, but I think it's a really interesting customer segment, are self-managed super funds. There's a lot of them. There's over 1 million self-managed super funds trustees in Australia, and they hold a lot of assets, over $700 billion worth of assets. And they love holding their assets on that CHESS-sponsored or broker-sponsored HIN. In fact, $263 billion of that $700 billion is held on CHESS, on ASX's infrastructure. Now, historically, one of the problems with self-managed super funds is lack of diversification. So as kind of the story goes and the research shows, self-managed super funds typically hold a couple of the big banks and some miners and Telstra. But I think what we're seeing, especially over the last couple of years, is self-managed super funds diversifying into other asset classes using exchange-traded products or listed products that are available via the exchange. And when we look at the inflows over the last year into ETPs, we can see that over 60% of the inflows were into global equity ETPs and fixed income ETPs. So I think just further evidence that those self-managed super funds are trying to achieve diversification away from a portfolio of only direct Australian equities. And the third driver might surprise some of you, but what we've actually seen the adoption of listed products, and particularly ETPs or ETFs, by younger investors. ETPs, given their ease of transaction, provide really low barriers to entry as well as that they're fairly simple investment structures to understand for younger investors. ASX runs education seminars to investors, and we've seen over a 400% increase over the last number of years of investors aged between 18 to 39 attending our events, which is really pleasing to see from our perspective, investors taking the initiative to educate themselves about the market and about investing. ASX also runs an Australian investor study. Some of you may have seen this. We do this every couple of years, and really it's a survey of all Australian investors. And what's really interesting to see for what we call next generation investors, 42% of them access the market via an online broker, and 72% would consider using a robo-advisor. Now that doesn't mean that they have, and we think this is still at the very early stages, but it's just an indication of their adoption of technology. And just to wrap up, looking forward, what kind of excites us? One of our mandates of our team is to enable investors and financial advisors to be able to build institutional quality portfolios across all asset classes. And we think we're achieving that goal by working with partners like Pinnacle and other investment managers in the market. And across different asset classes, geographies and sectors, different strategies such as smart beta and also alternative asset classes, investors, I believe, can now truly build a diversified portfolio and hold their assets on that HIN, on that CHESS-sponsored HIN. And just finishing off, where's the opportunity for growth? What can we be doing better? I still think it's in that area of diversification. Again, in that Australian investor study that ASX produces, when we asked investors the question, 67% of investors surveyed said that they want stable or guaranteed returns of greater than 8.8%. Obviously showing a real disconnect between investors' understanding of risk and reward. So I think we've got a lot more work to do there. When asked the question, is your investment portfolio diversified? 45% believe that they did have a diversified portfolio. But what's worrying is 55% either believe they did not have a diversified portfolio or were unsure. So again, a lot more work to do there. And just not to take our own study, but looking at the class SMSF benchmark report, the graph on the right-hand side, it's probably a little bit hard to read, but what we're looking at is the first bar chart on the left is looking at the underlying data of all of Class Super's self-managed super fund customers. And you can see the little blue bar on the far left. That's their exposure to international equities. About 5% of the entire pool of self-managed super funds, 5% of their asset allocation was towards international equities. Now, when they dug a little bit deeper into those self-managed super funds that are their customers who use managed funds, going all the way to the right-hand side, we can see that their exposure to international equities increases significantly, which is a great thing to see. So again, further education around the benefits of diversification and how to get diversification through managed investments.